Bloomberg Audio Studios. Podcasts, radio, news. This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been in U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
On today's Bloomberg Intelligence show, we dig inside the big business stories impacting Wall Street and the global markets.
Each and every week, we provide in-depth research and data on some of the 2,000 companies and 130 industries our analysts cover worldwide.
Today, we'll look at why Apple is investing $500 billion in the U.S. over the next 4 years.
Plus, we'll discuss how the global retail giant Walmart is navigating a second Donald Trump presidency.
But first, we begin with big tech and the chip giant Nvidia. This week, Nvidia reported good, but not great earnings.
The company also warned that gross profit margins will be tighter than anticipated as it rushes to roll out a new chip design called Blackwell.
For more on this, we were joined by Gene Munster, managing partner at Deepwater Asset Management.
We first asked Gene for his take on Nvidia earnings.
Well, the results were good, but not great. And specifically is the margin guidance at 71% versus the street at 72%. And there weren't whispers that they were going to lower margins. I think that really stood out to me. The upside on revenue, $1 billion, compares to the expectations of like $1.5 billion to $2 billion. And so I think that these were good in the sense they did raise on revenue, but not great. Effectively, what they're doing is pushing the ramp to the back half of the year, especially on margins. That's when the margins, they said, to kind of go to 75%. And I would add one other piece to this is going into the print. I believe that the most important point was related to commentary about how sold out they were on Blackwell. This is a metric that they typically give. And last quarter, they said they were sold out for basically 3 quarters of this year. They were radio silent on the topic. They surprisingly didn't get asked a question on it. But I think that Jensen's comments about the need for compute being 100 to 1 million, I double checked that on the transcript, 100 to 1 million times more compute needed for reasoning and physical AI and robotics AI, that increase in compute, I think gave investors some optimism that, well, this year might not be the year, that 2026 is going to grow faster than what people think. And so said a different way is that the results and guidance don't give a ton of optimism, but if you look at where this ultimately could go, if you take what Jensen is saying and divide it by 10, that means they're still going to comfortably beat the numbers next year.
Okay, there's a lot to unpack with that. So let's go back to gross margins for a second. Based on their call that gross margins will hit 75% in the back half of the year, when do we think they're going to bottom?
So they answered that question on the call, and they kind of sidestep it. But if you read between the lines, they probably go lower again in the July quarter. So there's an April quarter that we're in right now, then they go to the July quarter. My guess is they probably bottom then at around 70%. So effectively going from 70 to 75 over 6 months is a pretty big jump. At the time of the call, the stock was up 2% in after hours when they came to the last question on the call, which was related to that ramp in margins and how realistic is it if we have more export controls. And the answer was, we don't know how export controls are going to impact our business. And immediately the stock went from up, call it 2%, to down 0.5%. So we saw basically a 2% move in it. And so I think that speaks to investors saying, like, that's a risk here, is like, are we really going to get to that margin ramp? You talked about the 73% margins for a tech company, for a hardware company. I think at the end of the day, they're still remarkable. But for these stocks to keep working, you need to have margins at a minimum stable and growing. And I just want to put one final thought on this, Alex, is that ultimately, I think margins will get back to that 75%. I don't know if it's going to be in Q4 or early next year. But if the ramp is what I think it's going to be for next year, I think we're going to get back to some go-go days in Nvidia.
Gene, the driver for this stock, tremendous performance over the past 2 years, has been beat and raised by a certain order of magnitude. If for no other reason than the law of large numbers, that order of magnitude likely will be lower. Can this stock continue to work with just the law of large numbers not giving you that $2, $3, $4 billion beat and raise every quarter?
I think it can. And just to put it in perspective, we've gone from a $20 billion business a few years ago. It's going to be about a $200 billion business this year. But there still are companies, Apple's a $400 billion business. I mean, you can still continue to grow from that. And it doesn't need to have that breathtaking growth. And I would come back to the central question here. It's not about 2025. It's the 23% growth in calendar 26. And do you think that the number is going to be higher or lower than that? And ultimately, I think the number is going to be higher. I think we're going to get back to a point where we, despite the law of large numbers, we get to some of those improving upsides and beats. And it just comes down to what I think is a large TAM and what I still believe is a competitive advantage that GPUs have over custom silicon. And we'll see how that plays out. But that's essentially the debate that's going on right now, is just how much compute you need and how defensible is Nvidia. I think there's a boatload of compute, much more than we realize it's going to be needed. And I think Nvidia is in a great position related to that. We're going to have to wait to get to those results. But I think anticipation of that is going to be positive for the stock at some point this year.
Our thanks to Gene Munster, managing partner at Deepwater Asset Management.
We move next to the energy sector. This week, we looked at the energy technologies company American Superconductor Corp. Its NASDAQ ticker is AMSC.
The firm specializes in using superconductors for the development of diverse power systems. And the hope is to meet the world's demand for smarter, cleaner, and better energy.
AMSC also recently reported third quarter earnings and said its revenue grew 55% from a year ago.
For more on AMSC, we were joined by its CEO, Daniel McGahn.
We first asked Daniel to describe what his company actually does with regard to power.
We don't really make the power or move the power, but we make sure that the power is where it is when it's needed.
So what does that wind up meaning? So you conduct the electricity, basically?
Yeah, so if it's an industrial site in a manufacturer that needs power at a certain level, of certain frequency, we modulate that and make it the right way for that factory. Same thing if you're trying to deal with bringing generation onto the grid, or even different spots within the grid itself to bolster and make sure that the power can go where it's needed.
All right, that sounds critical, sounds important, but it doesn't sound sexy. Are you guys getting caught up in that AI and the need for energy? And
I think we're getting caught up in the need for energy. I think there's a lot of drivers that are changing our need for power. If you think about everything you do in your day now requires electricity. And that can be from healthcare to data to semiconductor manufacturing and everything in between. So power becomes more and more critical. We're becoming more dependent upon it. And the grid really wasn't built for the modern era of electricity.
And from that perspective, I mean, just for a super nerdy moment, you guys also make the conductors, right? Like the thing that, so if you have a wind farm and you need to attach it to a grid, there's like a piece of equipment that you need to attach it. You make those, and those are in super, super, super tight demand. Like tons of demand, not enough supply. Doesn't matter what kind of power source that is. Am I accurate?
Yeah, and many of the suppliers are from overseas as well. So we're kind of unique also being an American company making product in America with Americans. And I think that fits very well in today's climate where we're trying to push the country.
What are the drivers for your company right here, right now? I know you recently reported earnings. What did you identify as the drivers for your business?
A lot of it is this further need for demand. A lot of it, we're seeing our business start to ramp really with the reshoring of manufacturing capacity and capability in America. All those operations need power. So we see expansion in manufacturing that's starting to happen, particularly in these critical elements. If you want to deal with cars and chips and AI and all those things, we sit kind of secondarily that we help enable the power to be there, but more and more operations are becoming more dependent upon electricity.
So from that perspective, does it matter to you where the electricity comes from? In that, does the policy from a Biden administration and transition to a Trump administration on, say, energy and climate, does that matter?
Well, I'll say something that may not be popular, but I'll still say it. I think that the end result and desire from both are the same. We want to make sure that we're building an economy in America for Americans. I think that was consistent with the last administration. It's definitely consistent with the current administration. The question is the policy and how. How do we help enable it? Are we trying to create a market that companies want to invest in, or is the government trying to help foster that through money and through policy that is more economic? At the end of the day, for us, it doesn't quite matter. The problem is still the problem. The grid needs to be improved. Utilities are working on that, but as more manufacturing capacity comes online, there's need for higher quality power, and that's where we come in and help solve those problems.
Who do you compete against?
A lot of the big guys from Europe. And what we found is...
An example, would that be like Siemens? Or?
Could be Siemens or ABB. Locally here in the U.S., a small company called General Electric. But what we found is over the past several years, our largest competitors have become very good customers. And what we found is what we offer, the uniqueness of what we do and the service that we provide, it complements their offering. And I think they're starting to understand that we're not really a threat per se to their business. We're a helpful solution to the end customer.
What inputs do you need for your business? So what things are tight for you? What things do you want to help change?
When you say inputs, I think supply chain and
that's
capital.
that's what I'm trying to get at. So is it like the raw materials that you need to build stuff in the U.S. to then sell?
Yeah, almost everything that we make in the U.S., so probably 85% of our business is here, home in the U.S., manufactured here. Almost all of our supply chain, probably more than 95, 96%, is sourced in the U.S. So the current climate really puts us in a unique opportunity that we may have unique opportunities presented to us because we are American made by Americans, supplied mostly by American suppliers. When people talk about tariffs and these kind of external policies, they don't have a great impact on what we do. Now they may. I don't know how things are going to sort out. There's a lot of rhetoric, and then we'll see how reality translates from that rhetoric and really what gets put in place. But a lot of this is trying to push the country in a certain direction, and I think that general direction is good for us.
So are you having conversations with your customers now? They may be calling you and saying, hey, Dan, we're a little nervous about what might be happening over the next 3, 6, 12 months in terms of tariffs. Are you seeing that in your order flow, or are you seeing that maybe just in conversations you're having?
Yeah, we're seeing that from companies in Canada and Mexico. We're seeing that to some extent, some companies on the continent of Europe. But certainly in the U.S., they're comforted by the fact of where we make it and how we make it and where we source product from.
Some of the headlines over the last couple of days have revolved around tariffs on things like steel, aluminum, copper was thrown into the mix yesterday. If that winds up denting demand, as in we're not going to build as much manufacturing or industrial sites because it's just really expensive, how does that trickle to you? Well,
I think the opposite's going to happen. The need is going to persist. The question is, can it absorb the cost? And there's going to have to be a way to figure that out and find that out. But I think all of the things that go into the electric grid use all those materials. So they're going to have to get sources. And if it makes American-sourced product more competitive, then so be it. From my standpoint, it doesn't directly affect us because we're already sourcing most of our principal equipment from the U.S.
Our thanks to AMSC CEO Daniel McGahn.
All right, coming up, we're going to break down why the coffee giant Starbucks is cutting jobs across its corporate ranks.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney.
And I'm Alex Steele, and this is Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
We move next to news from the coffee giant Starbucks.
This week, the company announced that it's eliminating 1,100 corporate jobs.
The move by Starbucks is aimed at increasing efficiency and revitalizing the company.
For more, we were joined by Michael Halen, Bloomberg Intelligence Senior Restaurant and Foodservice Analyst.
We first asked Michael what he thinks of this week's news.
Well, every situation is a little different. I did a lot of TV and radio last year when Brian Nichols was hired, and I said he's going to instill a culture of transparency and accountability, and if you're not adding value, you're probably going to be shown the door. So this is really not a surprise to us. It's not a surprise to the street. It was communicated back in January, and we've seen a lot of senior management changes as well. This was a company that was performing pretty poorly under the previous management team. I'm sure there was plenty of dead weight in that large company, so not really a surprise here.
What about them cutting all the drinks, like all the stuff my daughter likes to order? But I was thinking, I joke, but really, she's not going to want anything from Starbucks now, and they're no longer training her as a 10-year-old to then come into Starbucks as they get older.
Is that a bad thing?
Not for me, but I'm guessing for Starbucks, maybe.
Well, I think what they're trying to get back to is what made Starbucks great. How did Starbucks get to be tens of thousands of stores globally? It was really by through the espresso drinks, through a great in-store experience where the barista knew your name, right? And so they're trying to get back to a lot of those things. You know, they're looking for that core guest that's coming in there multiple times a day and providing them a great experience. I think that's a smart path forward.
Mike, you cover the whole restaurant space here. You see the different price points. What are you seeing out there? How's the consumer doing from maybe just the data you see about restaurant activity?
Yeah, so last year was a restaurant recession. You know, we think things will be a little bit better here in 2025, but it's been choppy kind of to start the year, and a big problem has been this cold weather. January was the coldest,
no kidding.
Coldest January in like 14 years, I think, in the United States. There was a significant amount of snow throughout the United States in January and February, so there's been a lot of closed restaurant days, and so it's been a choppy start to the year for the restaurant space. You know, we think it's going to be better than 2024, but you know, we don't expect the gangbusters year, mainly because of inflation still continuing to crimp low-income consumer spending.
Yeah, and also, you know, for example, coffee prices are really high. Egg prices still really high. Like those things are pretty sticky. Going back to Starbucks for a second. So the CEO, Brian Niccol, took over in September as sales were declining. Obviously, he's formerly of Chipotle. Do we have this playbook from Chipotle and then how it's being implemented, say, into Starbucks? And if so, kind of where are we in that?
Yeah, it's a little bit different, but similar, right? It's going to be, number one, it's going to be about nailing the operations, and they've worked hard to make the jobs easier for the baristas. You know, part of the reason why they're not offering your daughter's favorite drink is because they were difficult to make, right? And it's because the baristas really didn't personally want to make them. They added labor hours into the cafes to help boost operations, right? And then from there, it's been spending more on marketing. This company has underinvested for a very long time on marketing, and now you know, they've been able to do that. They sell an item that's pretty addictive, caffeine, right? So, but they've underinvested in marketing for a long time, and Starbucks is starting to push the gas pedal on that, and they're saying they're starting to see better transaction data in the U.S. and we're starting to lap some really weak results from last year, and so you know, I think we're going to start to see some momentum on the top line here for Starbucks, especially in the United States.
Our thanks to Michael Halen, Bloomberg Intelligence Senior Restaurant and Food Service Analyst.
We move next to news from the tech giant Apple. This week, Apple said it will hire 20,000 new workers and invest $500 billion in the U.S. over the next 4 years.
Now, this comes as Apple seeks relief from President Donald Trump's tariffs on goods imported from China.
For more, we were joined by Mark Gurman, Bloomberg Chief Correspondent on Global Technology.
We first asked Mark how this news came about from Apple.
During the first Trump administration, Tim Cook, other companies were obviously very worried about tariffs, right? And so their strategy was, we can try to make a deal here. What does Trump want? Trump wants his supporters to know or see that he's bringing jobs back to the U.S., bringing money back to the U.S., bringing manufacturing back to the U.S. Apple doesn't want tariffs on the phone, and it wants to keep as much phone manufacturing in China as possible. We don't have to get into the reasons why. There's a ton of them, okay? So you have these two sides, right? There's a universe in which both parties can get exactly what they want. It's like a trade, right? And so you saw that strategy in full form. Trump, for months, obviously, the second administration has been talking again about bringing back jobs, has been talking again about moving things to the U.S., has been talking again about extra tariffs on goods from China. So Apple comes out with a press release. We're investing $500 billion in the U.S. over the next 4 years, which, by the way, that's Trump's term, right? He just started, okay? 20,000 new jobs, AI server manufacturing with Foxconn in Houston, doubling our manufacturing fund from $5 billion to $10 billion, setting up a manufacturing academy like a school in Detroit. So you ask yourself, what's really going on here? They want Trump to know that they're investing heavily in the US, and since we're doing that, we don't want tariffs. And so the spin to Trump is that we're doing this because of you. The reality is somewhere in the middle. The reality is that Apple has been investing as part of its business operations in the US from the very beginning. The reality is in 2021, Apple announced a $430 billion investment in the US. The reality is that Apple hires 4,000 R&D employees a year in the US anyways. So what's actually new here? To be fair to both Trump and Apple, there is a bit of an acceleration. So their typical spend under the 2021 US investment plan, $86 billion annually. Okay? The new plan, $125 billion a year annually. So you're getting a $40 billion jump under Trump, and you're moving from 4,000 people on the R&D side hired annually to 5,000 people. So incremental, sure, but definitely an acceleration.
Okay. 1 minute. Is there a quid pro quo here? Do you think Apple actually already has a deal with President Trump that they will be exempt from tariffs?
No.
Okay.
But Tim Cook went to Donald Trump's office last week and presented this to him, said, we're going to do this because of you, man. Oh, and by the way, we don't want to pay tariffs. And Trump knows that. Trump doesn't care about giving Apple a reprieve on tariffs. He's happy to do it. And he's happy to do it and tell people that he did it because Tim Cook is investing $500 billion during his presidency. He can go back to his supporters, his base. He can go back to Congress. He can go back to the world and tell them that the world's biggest technology company, the most famous company in the world, is investing $500 billion, its biggest investment commitment ever, right, because of me. And for Trump, that's awesome.
Yep.
And for Tim Cook, not having to pay tariffs is awesome. And I think that's good enough to get some sort of tariff reprieve. And by the way, let's say Trump doesn't give them a tariff reprieve. Who cares, right? I was doing this anyways if I'm Tim Cook.
Our thanks to Mark Gurman, Bloomberg Chief Correspondent on Global Technology.
We move next to earnings from the home improvement retailer Home Depot.
Home Depot said it expects a key sales metric to return to growth this year. And this comes despite the company cautioning that housing demand won't change significantly in the near term.
For more, we were joined by Drew Redding, Bloomberg Intelligence U.S. Homebuilding Analyst. We first asked Drew for his take on earnings.
It was a good quarter for them. Comp sales were positive for the first time in 8 quarters. So I think that's something a lot of people are latching onto and a positive indicator moving forward. You know, we came into the quarter thinking that they could do a little bit better than consensus on the comp line, really because of some of the positive data we've been seeing coming through in retail sales, along with the expectation that some of the recent hurricane activity would benefit them. And that's something they called out. They had about a $200 million benefit from hurricanes, which is about a 65 basis point lift to comp sales. The guidance was pretty positive. They're looking for about 1% growth next year, which we think is appropriately conservative. And it's pretty much in line with what we've heard from some other players in the home improvement space who are looking for the market to be flat to modestly higher next year. There's really no incentive for them to come out and be overly optimistic for next year, given the struggles we're still seeing with housing.
I was struck by the fact they said they are seeing more refis. Does that mean that people are going to refi to then spruce up their house?
Yeah, I mean, in order for this industry to see more normalized growth going forward, that's something you're certainly going to need to see is people tapping that home equity, undertaking larger scale renovations. It's still one of the areas that's kind of holding back growth. They cite it, kitchens and baths as a particular area of weakness. Oh. And the reason is because those projects are typically financed. So while they did mention that they saw a little bit of improvement, it's still nowhere near, what the industry would need to see in order to get more robust growth going forward.
Hey, Drew, it may shock you to learn that I spend very little time in either Home Depot or a Lowe's. How does the street differentiate between the two? Because I'm looking at the stocks over the last 5 years. They're both up, 11, 12, 13% on a compounded basis. Did the same shareholders own HD? Did they own Lowe's as well? How do you differentiate?
Yeah, so the main point of differentiation between the two is really their customer exposure. You remember Home Depot is about 50% DIY, 50% professional contractor, whereas Lowe's is about 70% DIY, 30% pro customer. As we look forward, we think that the primary engine of growth for the industry is going to be from professional contractors. As you start to look out ahead and you do see people tap that home equity, we think that's where a lot of the growth is going to come from. For Lowe's, as I mentioned, they've really been focused on DIY, but over the last couple of years, they're starting to transform their business to cater more towards that professional contractor because I think they realize that's where the growth opportunity is. Mm-hmm. Now, for Home Depot specifically, their strategy is to go after an untapped $200 billion market for more complex pros, which are those looking at, larger scale remodeling projects that span a lot of product categories. And they want to consolidate those contractor vendor relationships so they could become the one-stop shop.
So if lumber is such a big part of these businesses, what are they saying about tariffs? If I would guess they get a lot of their lumber from, I don't know, Canada?
Yeah, so surprisingly, it wasn't really an emphasis of the call. Okay. Home Depot and Lowe's are among the largest importers of goods, as you would expect. But over the last several years, the point is really that since the last time this administration put larger tariffs into place, they've really diversified their supply chains out of some of the markets that are most dependent, like a China. Now, a majority of their products, their cost of goods, is still sourced domestically, but they certainly do have exposure to China and some other markets, and we would expect to see somewhat of a margin impact, as these tariffs continue to go through.
Our thanks to Drew Redding, Bloomberg Intelligence U.S. Homebuilding Analyst.
Coming up on the program, a look at how Walmart CEO Doug McMillon is navigating a second Donald Trump presidency.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney.
And I'm Alex Steele, and this is Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch the program live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
We move now to investor Warren Buffett's multinational conglomerate, Berkshire Hathaway.
The company recently said its fourth quarter earnings were about $14 billion higher than analysts expected. Berkshire also said that it has more than $334 billion in cash, a record high.
For more, we were joined by Matthew Palazola, a Bloomberg Intelligence Senior Analyst for P&C Insurance.
We first asked Matthew what some of the highlights were from Berkshire's earnings report.
Big earnings jump from the year ago due to their most exciting and best business, in my view, the insurance business. We've been probably talking a while about auto insurance prices going up. And that is really showing through in the results of auto insurance companies like Allstate, Progressive, and Geico at Berkshire. So that was one of the big drivers. Another one was their investment income. So they've been selling a lot of stock. As you said, their cash pile, which is $334 billion, going up and up. And the investment income on that has rose dramatically as well.
So how much cash does he have now?
So it's $334 billion in cash. That's just cash.
That
not
hurts
even
my tiny little brain.
Yeah, yes. I mean, good problem to have, right?
Especially when rates are going up.
Yeah, I mean, and what has happened is...
So true. Oh my God, can you imagine? Yeah. Put that in a markets fund, what you're throwing off.
So they're getting about $11 billion in investment income a year just on their fixed investments. And that's incredibly short-term, T-bills.
Right.
The reality is the problem, if there is a problem, is, and it's been this way for years, and there's just nowhere to put that money. I mean, to find something of that scale is almost impossible.
Yeah, he talks a lot about that there's not much they can do to move the needle on results. They bought Allegheny a couple of years ago. That was $13 billion. They've put, I don't know the exact number, but several billion
good buddy mine.
Into these Japanese trading house investments. So they've been putting money to work, but none of those really move the needle. And they sold a ton of Apple stock. They sold, in the fourth quarter particularly, they sold a bunch of Bank of America stock, which we knew was going to happen. So there weren't really any other surprises as far as stock moves. They bought Constellation Brands, which is, makes beverages. I don't know all that much about them. They put about $1.5 billion to work at that.
So what does Warren Buffett say about the market being overvalued or not? And what does he say about, say, AI trade?
Probably not much. He didn't say, nothing that I've heard, Warren Buffett in interviews or anything. We've got the annual meeting coming up in May. So I would be shocked if he doesn't get one question on AI, at least at this point. They're not huge investors in tech names, obviously Apple notwithstanding. The investment managers might be more interested in stuff like that. And he had said in his annual letter it won't be long before Greg Abel's the CEO. So he kind of always acknowledges that and kind of more building towards the future.
So if I'm buying BRK today, Berkshire Hathaway, what's my investment theme?
It's tough because in the earnings, I didn't see a lot of things that were, telling me, oh, these are positive signals for the future earnings of Berkshire necessarily. Berkshire's got a huge retail ownership, so there's kind of some of that moves it. The fact that the earnings beat by a lot didn't impress me. We knew about Geico improving. They also had a lot of insurance favorable loss reserve development, which means they sell the business, their claims come out later, so they don't know the claims. What happened is their claims turned out to be a lot better. But in the third quarter, they had adverse development. So the things that pushed their earnings were not too impressive. The operating businesses like the railroad had a one-time comp expense in it. It seems to me like earnings probably will not grow in 25 just because of these items in insurance. And even the other underlying businesses, it'll be modest if much growth at all.
So because I'm me, I'm really into Warren Buffett's stake in Oxy. Mm-hmm. So it's an oil company, but they're also doing a lot of direct air capture, and which basically you get carbon out of the air and you put it in the ground. But the reason why he has this stake that he continues to build, but originally it was when Oxy was buying Anadarko and they needed some funding and they needed it fast. And so he got a sweetheart deal. The rumor always is that, he's going to buy the company.
Mm-hmm. So he flat out said, I'm not looking to buy the whole company. I think it was at the last annual meeting.
Yeah.
And I was writing the day before, maybe they'll buy Oxy.
Okay,
and,
fair enough.
So and then he came out and literally threw cold water on it. They did buy more stock in the fourth quarter and the first quarter. And like you said, Alex, he made a very typical Buffett deal. Like, this is a company that desperately needs cash. We're going to get a great deal from them. But he has repeatedly talked about the management of the company and how he likes how they're positioned. So I don't think it was, it wasn't just taking that sweetheart deal. He does like the forward look of the company. Also, Greg Abel, the future CEO, is an energy guy. So I assume he played, a big role in that whole deal.
What about this Abel guy? Do we like him? We've now had a few years to get to know him, right?
I think we like him. We don't know a ton, honestly. Buffett has him with him in interviews. He has him in the annual meetings. He will be there again. I think they said it in the report. He'll be there for, I believe, most of the time with Buffett. Mostly what I'm going on is how Buffett talks about him. Mm-hmm. Talks about him in terms of capital allocation. He always praises his managers. One thing I think you could point to is that Abel has taken over a lot of the day-to-day. So a lot of the managers of the companies Berkshire owns call Buffett, and he's kind of nicely, gently passed them on to Abel. If things are going well, they're probably going well due to Greg Abel's effort.
Our thanks to Matthew Palazola, Bloomberg Intelligence Senior Analyst for P&C Insurance.
This week, we focused on a Bloomberg Big Take story entitled, Walmart Wants to Be Something for Everyone in a Divided America. You can find it on Bloomberg.com and the terminal.
The story looks at how Walmart's CEO Doug McMillon is navigating a second Donald Trump presidency while going after Amazon's e-commerce crown.
For more, we were joined by one of the story's authors, Devin Leonard, Bloomberg Businessweek's senior global business writer. We first asked Devin about how Walmart is trying to position itself today.
Well, I mean, it's just a really interesting time to be doing a story about Walmart because it's Doug McMillon's, I guess it's just a little past his first decade, and he took the company through this transformation. When he came in 2014, they were just, considered internet clueless. They were behind not just Amazon, but eBay and Apple. And, he sort of turned them into, an actual, Amazon rival, or, at least they had a future. So now he's trying to do, trying to turn it into sort of more of a real tech company with its big expensive campus, and also all of these, not just Walmart.com, but a marketplace for third place sellers, online advertising and all those things. And of course, as you pointed out, he's trying to do it, all at a time when Donald Trump's come back, to Washington, and very aggressively pursuing the second term agenda. But they're trying to hold on to their I don't want to say downscale customers, but their core customers, while reaching out to upscale customers, primarily online, and also navigating tariffs and all that stuff, but also kind of moderating his sort of political positions, or positions on social issues as CEO, as we've seen in the last couple of months, rolling back DEI basically not being as critical as Trump, as he was during Trump's first administration. So, it's a difficult kind of balancing act, but that's what he's trying to do.
Well, also in the piece, you guys talk about their opening of the 350-acre Walmart campus. The pictures are amazing. It's not yet done, but they have like a fitness center, they have meditation rooms, they got pickleball courts, shops, restaurants, a brewery. Like, what now?
Well, it was pretty fun. Just the whole town has changed a lot. J1 had actually been there a couple of times more recently because she covers Walmart all the time. The last time I was down there was 2005 when I wrote a cover story for one of our competitors about Fortune. About Fortune. Fortune was the magazine. It was a piece about Walmart, but we spent 4 days down there. The last day we were really on campus and everything. But both Macmillan and Walmart and the Walton family, who control 40% of the company, they're trying to both turn the company and Bentonville into a place that will attract the top talent people who from Silicon Valley who might not have come to Walmart and to Bentonville otherwise. So it's all part of a big push to do that and to retain people. As they become this company that's with the top ranks. It's not a bunch of lifers anymore. It's people from PayPal, people from Amazon, people from Instacart and all that stuff. So that's really what that's all about.
And I guess the makeover of Walmart into a really extraordinarily competitive digital player in digital retail and digital e-commerce, competing very well against Amazon, that's not cheap. And it impacts their margins. No, well, I guess they've got a board that is supportive of this fellow.
Well, that was a really interesting thing because we were down there, I guess this was on January 17th, and there was a press conference where, Macmillan and also the governor of Arkansas, Sarah Huckabee Sanders, and others gave a whole presentation all, about the company and the new campus. But meanwhile, Macmillan had given a speech earlier in the day. It was just an employee-only event. I should actually say J1 did this, but she was able to get a recording of the earlier speech, and in that Macmillan, who's very, very almost Zen-like and sort of unflappable, gave a more sort of spirited speech, and he's basically saying like, we made this transformation, but there's so much more we have to do, and it's really expensive. And he pointed to this chart behind him showing how their operating margins just dropping, and they're starting to go up a little bit, but it really was. That was pretty incredible. He said, I want to thank the board for not firing me because CEOs get fired. But it was really revealing and a great thing to have, and kudos to my co-writer.
Our thanks to Devin Leonard, a Bloomberg Businessweek senior global business writer.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.